In this video, I'm going to break down the new rules of income protection and explain these to you so that you can make smarter decisions about your current insurance and any future insurance planning that you do. Hi guys, welcome back to the channel. My name's Craig and I'm a self-confessed insurance nerd. And on this channel, I try and humanize the world of insurance to help provide peace of mind for you and your family. Income protection is something that's been around for a really long time, but in recent years, there's been some important changes that affect how it works. So today we're going to take a look at these key points and see what they mean for people like us who are trying to work out what the best path forward will be. Back in 2019, APRA, who regulate the insurance industry amongst other things, were forced to step in to improve the sustainability of the income protection market. At the time, the life companies had lost a combined $3.4 billion in the previous 5 years. Now, I'm sure when you hear that number, you feel really sorry for the insurance companies. But the reason these losses are important to you is that the lever that these insurance companies pull to fix these profitability issues are generally the price that you pay for your premiums, meaning they put their premiums up, which absolutely nobody likes. There are 5 main changes that APRA are bringing in. The first change was brought into effect at the end of March in 2020, which saw the stop of the sale of agreed value income protections to new customers. If you're not familiar with what the agreed value means, check out this video for a bit more information about how the differences work. From the 1st of April 2020, all new income protection policies are being sold as indemnity contracts. If you have an existing policy that's an agreed value policy, you can still maintain and make changes to this. However, even if you do hold this policy, we're finding that you're being forced to review the appropriateness of this agreed value as the life companies are tending to increase the prices on these older policies. The second round of changes are due to come in this year on the 1st of October. Whilst we're still not 100% clear on what these policies will look like, the Actuaries Institute have brought out an example product, and a lot of the life insurance companies are working towards a solution that's similar to this one. We are given enough indication to know what the likely changes are going to be, which is what I'm going to run through with you today. These changes can be a bit overwhelming, so I've tried to break them down and simplify them for you as much as I possibly can. The first change is going to be a limit to the way that income is calculated at claim. APRA has stated that benefit payments should be linked to the income at risk at the time of claim. Currently, some indemnity contracts allow you to look back for up to 3 years and pick the best 12-month period out of that 3 years to justify what your income is when you look to claim. The argument is that by doing this, there's a chance that you'll actually end up better off by claiming on your income protection than you would if you returned to work. APRA have stated that as of the 1st of October 2021, your income will be assessed as the income that you earned in the 12 months prior to your claim for those of you with stable incomes, so think employees, with some scope for those of you with variable incomes, so those who are self-employed or earn commission or bonuses, to have some averaging for a reasonable time based on the occupation that you have. So what does this mean to you? If you have a stable income, so you're an employee, this won't mean a great deal of change for you. It would still have an impact though if you were to take some extended time off, so when we can travel again, if you took a bit of a break from work, or if you took some time off for maternity or paternity leave, which are still unclear how they would be treated. If you have a more variable income, if you're self-employed or you earn income from bonus or commission that you have insured for your income protection, this point is certainly one that you'll need to consider and decide whether or not you need to take out a policy before October or after and run the risk of that average income over the period of time. Just in recent times, we've seen an impact from COVID, and I mentioned this before, but the impact that this has had on people's income has been pretty big in some industries. So when I think about this rule, I wonder how this would be treated and whether there would be scope for unusual events like COVID to be factored into this average income. I imagine that there would be some allowances made based on precedents that have happened in similar events from the insurance companies, but it certainly is a grey area, and when it comes to insurance, I hate grey areas. The second change to come in later this year is there'll be a cap applied to the replacement ratio. Now, APRA's concern here is similar to the earlier one, is that excessive income replacement ratios could leave you in a better position being on claim than you would be if you were to go back to work. They argue that this reduces the incentive for you to go back to work, and could also lead to you paying more in premiums for things that aren't crucial to you as part of the policy. Some of the examples that they've given are excessive indexation that have been applied to your monthly benefit. So you might have seen that if your policy's in place, the monthly benefit growing over time. Another example is not reducing the benefits that you receive if you work up to 10 hours a week whilst on claim, and also additional benefits that are part of some of these policies, such as rehab benefits or specific injury benefits and those sorts of things. To combat this, APRA have put a cap at 90% of your income at time of claim for the first 6 months and 70% from then onwards. There is also a limitation that's been applied to the monthly benefits whilst on claim. So what does this mean to you? For me, this is one of the changes that I think most of us will understand and accept. Income protection is designed to help maintain a lifestyle, not to improve it. For those of you that I've helped with claims, these extra payments that come from the insurance companies come as a surprise and you absolutely weren't expecting them. If the removal of these additional benefits provides a more sustainable product for all of us, then this is a change that for me, and I'd like to think for most of you, makes sense. The third change is a limited contract term to 5 years. Unlike the previous two changes, this is the first of the major impacts that I see from these proposed changes by APRA. One of the main features of individual insurance policies here in Australia is that they are generally guaranteed renewal policies, which means that as the holder of this policy, assuming you continue to pay your premiums, your policy will remain the same without medical or financial review for the life of the policy. As part of these changes, APRA have announced that contracts issued after the 1st of October this year will be for a term not exceeding 5 years. As the policy holder, you have the right to renew at the end of this 5-year period, but it will be based on the prevailing terms and conditions at the time of each renewal. You won't have to be medically underwritten again at this renewal, but this renewal will look at any changes to your occupation, to your financial circumstances, think income, and any dangerous pastimes. So what does this mean to you? Initially, I'll be honest, I was really worried about this change, but having a bit more time to think about it, I can see how this makes more sense. My belief is that we all need to work towards what I call fair, and this means both sides, as customers and as insurance companies. My only concern is that when fair is not documented, it allows room for contracts to be relied upon and claims not to be paid. I'd love to think that we're all on the same side as customers and insurance companies, that we all want to see valid claims get paid, as opposed to lawyers for the insurance companies getting involved to reduce the amount of claims being paid. Within reason, I think some of these changes make sense. Let's take, for example, me as a financial advisor. If I apply for income protection as an advisor, and then in 3 years' time, I leave the industry to become a fireman. Thinking about this scenario, should the terms of my income protection contract change? The risk to the insurance company based on my occupation change has certainly increased. And to be honest, firemen struggle to get income protection at all. If in 5 years' time the insurance companies decided they couldn't offer me the policy anymore, would this be fair? To answer this question, I think we need to look at the market in a broader sense. Insurance relies on us with insurance as a whole to continue to pay our premium, as this is where the money for the claims that are paid comes from. If insurance is going to be fair for everyone and not just me, then we might need to accept that changes like the ones being proposed are necessary, and we can no longer rely on the way things have always been. Would it be personally annoying for me as an advisor who becomes a firefighter who could no longer have a policy? Absolutely. I could then look at other policy options such as TPD or trauma to compensate for this loss of income protection, but that leads to a couple of other issues that I think have yet to be addressed. The issue I see coming out of here is that if my health has also changed in that 5 years and I could then no longer get the policies that I need to replace the income protection that I couldn't have anymore, I'd be left in a position that I couldn't have protection that I might otherwise want. A way to combat this could be if the insurance companies looked at your health when you took out the original income protection policy, but this again would require a change for them when they're assessing applications away from what they're doing now. If we have that goal of moving towards being fair though, I think that this would be a fair move of the insurance companies to look at assessing that differently if they're going to be taking something away from us as well. Change number 4 is looking at long-term benefit controls. APRA's concern is that long-term benefit periods, which are how long you'll be paid should you go on claim, have an adverse effect on claim duration, meaning that they encourage longer than necessary claims. From the 1st of October 2021 again, APRA have announced that policies with longer-term benefit periods should have effective controls to manage the risks associated, including specific design features. These could include such as incentives or requirements for people on claims to follow medical advice, to participate in rehab or retraining activities. Again, as we're not 100% sure what these products will look like, some of the possibilities that are being considered are stopping the 2 age 70 benefit altogether, looking at a change in occupation definition from own to any occupation after 2 years. This for me is a major concern. Moving away from a 3-tiered definition of disability, which is currently for some policies hours, income and duties, to a 1-tiered definition that's solely based on important duties. And dropping the replacement ratio as we mentioned earlier in this video. Again, what does this mean to you? As with the last change, this is the second of the ones that I believe will have a major impact on you, and one that you should carefully consider. Part of the changes I think that you'll accept as being reasonable, which is the reduction in the benefit period to age 65 or to age 60. And the reason I believe you'll accept these are the things that you can plan for and things that you'll choose. They're known factors. Alternatively, the change from an own to any occupation definition is anything but a known factor, and it's something that you cannot plan for. Own occupation, as the name suggests, looks at your inability to do your current role, or the role that you've been accepted for when you applied. Any occupation, on the other hand, looks at your inability to do any role that you're qualified for by education, training or experience. When I talk about any occupation, I like to use it as the example, can you go back and work at Macca's? The reason that this change concerns me most is that whilst we all hope that we don't ever need to claim on our policies, we want to know that if we ever do need to claim, that we'll continue to be able to be paid on these policies for the benefits that we need. If at a later date the insurance company, for example, decides that I can go back and pack shelves at a supermarket, which I did do when I was 17, I don't want my payments from the insurance company to reduce just because I couldn't go back to my regular job, but I could go and do a role that I'd done previously. So what can you do from here? If you have income protection in place currently, I'd suggest it to be a really good opportunity to get a good understanding of what you have in place and why you have what you do. As of the 1st of October 2021, insurance policies will start to be grouped, and the insurance companies call this pooling of policies. For example, there'll be a pool of agreed value policies before 1st of April 2020, there'll be a pool of indemnity contracts before 1st of October 21, and there'll be a pool of these new policies issued after the 1st of October 2021. What we're already seeing is that depending on what pool you fall into, the insurance companies are going to price these premiums differently based on the perceived sustainability of these insurance pools. Some of the recent pricing changes that we've seen to income protection policies have already been big. Think mid-teen insurance premium increases with some insurance companies, right through to insurance premium increases of over 120% with some of the industry funds. By increasing the premiums on the policies that are more in your favour, the insurance companies are hoping that you'll jump from the older policies into the less feature-rich newer policies that they're bringing out. This is the behaviour that I absolutely hate, and I've been talking to the insurance companies about options for you to give up some of the benefits that are part of your existing policies rather than giving up the whole thing and jumping into the new product. Again, this has not been completely finalised, and I don't think we've seen the end of movements here, but it's certainly important to know what you have in place at the moment. And if you're thinking about income protection now and whether you should be taking it out, have a look at the changes that are ahead, the ones that are coming in on the 1st of October, and work out if any of these are important enough for you to take action ahead of that date. This video has been really focused on the upcoming income protection changes rather than how income protection works in general. If you want to find out a bit more how income protection works itself, check out this video, which I created a complete guide to income protection. If you can put up with my embarrassing overuse of hand gestures, there is some really good content, and I'll see you over there.